Let's talk about 2022. Everybody wants to know what's going to happen to the property market. Will interest rates go up or down? Will we see more government stimulus because of the new COVID variant? Will we see another year of strong growth? Which markets will outperform and which markets will underperform? In today's video, we are going to review the forecast by our major banks, as well as discuss the threat of the new COVID variant and the possibility of further government stimulus, as well as extensive lockdowns going forward, and how all of this will affect the housing market on a macro level. We've got a huge one today, so I'll get straight into it. But please remember, I am not a financial advisor. These are simply my personal opinions and strategies, and I will always recommend you to do your own independent research into everything we talk about today. Let's start by talking about a new headline that's been popping up a lot lately: the spread of the new COVID variant, which has already made its way into Sydney, Melbourne, and now Queensland. Based on the number of exposure sites and the rising case numbers, it seems like this new variant is spreading very quickly. So what does this mean for Melbourne, Sydney, and Queensland? Based on how fragile both Melbourne and Sydney are from their extensive lockdowns last year and this year, it is very unlikely for the state governments to put us into another lockdown. It will be their last resort. If the new variant turns out to be more severe or fatal compared to the previous one, and if our vaccine is ineffective against it, we could very well be facing another lockdown. Based on early research by the World Health Organization, the Pfizer vaccine could be up to 40% less effective against the new mutated strain that originated from South Africa. But the good news here is that early studies also indicate that the new variant does not make people sicker than Delta and the other variants. If anything, the data is showing that it is less severe and less fatal. It is still extremely early, and a lot of the research that is coming out is not conclusive. So it will be very hard to tell how the government is going to react and which policies they will introduce to combat the new variant. However, due to all the uncertainty surrounding the new variant, we could see that the reopening of borders could be delayed even further, at least until more conclusive research is released or a new vaccine is developed. This is a very important factor to consider because when our borders finally reopen, we are likely to see an influx of migration, which is going to be crucial for the recovery of the Australian economy. This will also put additional demand on housing, which is likely to offset the decrease in demand for owner-occupiers and first-home buyers who are becoming priced out of the market. So this is definitely something we should keep an eye on as we head into 2022, because it will definitely be a nice little boost for the housing market when migration do return to Australia. Let's now talk about interest rates. Just in case you haven't noticed, despite the RBA's decision to keep interest rates at a record low of 0.1%, our major banks have completely ignored that and decided to increase the interest rates on their own. NAB was the last major bank to offer a fixed rate that is below 2%, but that has changed now, and all of the major banks are now preparing for a higher interest environment. If we look at this graph provided by Rate City, we can see that all four of our major banks have increased their 3-year fixed rate in a very aggressive manner over the last few months. I also think the Reserve Bank of Australia will increase interest rates much sooner than 2024. And I think the real inflation in Australia is much higher than 2.5%. With inflation getting out of control and the housing market going crazy, higher interest rates seems like a reasonable response. To give you a rough idea of how bad the inflation issue is and how hot the property market is, we have managed to add $2 trillion to the value of Australian real estate over the last 12 months, giving Australian real estate a brand new value of $9.3 trillion, which is absolutely insane. Almost all of these $2 trillion added to the Australian real estate market over the last 12 months has come from cheap debt offered by the government and the banks. And with interest rates on the rise, the cost to service this massive debt is going to increase significantly. And I believe the homeowners in some of our markets are going to really feel the heat and the pressure to serve these higher repayments. So please be careful if you're looking to get into the market. Now is definitely not a time to stretch yourself. Just because the bank is willing to lend you a certain amount of money, it does not mean you should borrow all of it. Let's now look at the growth projections for 2022 and see what the major banks have to say about what to expect. According to this article by news.com.au, the economist team at NAB actually increased their growth forecast for 2022 from 3.6% to 5% on the back of low interest rates and strong income support from the government. One thing that we should understand is that this prediction is for the Australian property market as a whole, and there will definitely be markets that will outperform this number and markets that will underperform against this benchmark. The team at ANZ gave a similar prediction, and they expect to see a growth of around 6% in 2022. And Australia's largest bank, CBA, also gave a prediction of around 7%. This is what they expect to see on the housing market in the next year. While all the major banks are optimistic about what's going to happen in 2022, they are all predicting a correction in 2023, with the CBA predicting the correction of up to 10% in 2023 after the market's peak in 2022. And to be completely honest, I do not disagree with this forecast. I definitely think we could see a minor correction in 2023 because it has become so hard for people to get big loans to service their massive mortgages and to keep driving up house prices. Another graph that I would like to show you is the value of the new home loan commitments. As we can see here, the total new home commitments have dropped over the last few months, largely due to a sharp drop in our owner-occupier activity. And the only thing that has increased is the level of investor activity. This tells us a number of things. The first-home buyers and the owner-occupiers are starting to be priced out of the market, and affordability constraints are really starting to kick in. 2, the level of FOMO in some of our markets is definitely starting to die down. And finally, because of this sharp increase in investor activity, it is likely that there is much more speculation in our markets now compared to previously, because different to first-home buyers and owner-occupiers who are looking to purchase a property to live in, investors are purchasing these properties purely on speculation and expecting these values to grow in the future. If we now look back to the last property cycle that ended in 2017, when APRA stepped in to cool down the market and impose tough new lending practices for interest-only loans and to reduce the level of investor speculation, a very similar cycle is now playing out. The first-home buyers and the owner-occupiers were the first to come into the market to drive up house prices. And as they became priced out, the investors came in and kept the market going towards the end of the property cycle. And as the owner-occupiers became priced out of the market, and as the level of investor activity increased, which meant more speculation in the market, it therefore encouraged more government action to slow down the market and achieve a soft landing. If we reference what happened from 2017 to 2019, when the property market took a turn, it is very similar to what the banks are predicting, with a correction in 2023 for Melbourne and Sydney. If we look at what's happening in these markets right now, we are already seeing a sharp increase in the number of new listings hitting the market, and this is with us heading into the holiday season. Once everyone has had a nice break and we get back to work in January, I believe we will see even more listings come onto the market. This is definitely going to reduce the level of FOMO in some of our markets. And even before these additional new listings came onto the market, affordability constraints were already there, meaning people were buying less and they weren't able to spend as much. This combined with how sensitive these markets are to interest rates, I am very glad that I do not have a lot of exposure in Melbourne and Sydney. Again, this is only my personal opinion and I could definitely be wrong, but I personally do not expect Melbourne and Sydney to be the best performers going forward, especially if the reopening of our borders is delayed further. Another market that I am personally very cautious about is Tasmania. You guys know that I have a lot of investments in Tasmania, and this has been one of my favorite markets over the last few years, and it has done extremely well for me. Because of how well Tasmania has performed over the last 5 years, a lot of people are investing into this market expecting to see similar results going forward. One thing that we need to remember is that past performance does not guarantee future returns. And another thing that we need to understand is that Tasmania has the lowest minimum income in Australia, and affordability is becoming a serious issue over there. And people are struggling to get the money together to get into these properties. If anything, due to how well this market has performed over the last 5 years, where most properties have doubled in value, it is very unlikely for us to see this kind of growth going forward. And I actually think this market is due for a small correction or some form of pullback. Don't get me wrong, this market is still looking very strong in terms of supply and demand because the housing shortage is still very bad. And it has one of the strongest rental markets in Australia with the lowest vacancy rate in Australia. However, if you're investing in this market with the expectation that it will double in 5 years' time, I think that is very unrealistic. Let's now move on and talk about Queensland. I personally think this market is going to do quite well in the coming years. It has the strongest population growth in Australia, a very strong economy, and all the hype surrounding the 2032 Olympic Games. There are definitely a lot of exciting things happening in Queensland right now, especially in Brisbane, but this is the market that can be a bit risky because of how competitive it is right now. Over the last 12 months, some parts of Brisbane have gone up 20, 30, or even 40%. If a property or suburb has gone up by 40% in the last 12 months, how much more growth can you realistically expect from the market going forward? Another thing that we should talk about is the government spending over the next decade. A lot of people in Queensland, a lot of people who are buying into Queensland are expecting the government to spend a shitload of money into this economy, which in turn is going to drive job growth, lead to higher wages and more money for the Queensland economy. However, the one thing that a lot of people don't understand is that a lot of this infrastructure for these games have already been built. Sure, they'll still spend a bit of money making it more modern and more presentable, but the infrastructure, the stadiums and some of the networks are already there. So the government won't be spending as much money as most people are expecting them to spend. Another thing that people are ignoring is that all of this government spending will have to eventually be paid back. We can't keep growing this deficit forever. And the best way to reduce the deficit is through taxation, which means higher taxes. And if we are paying higher taxes, it means people have less money to spend on housing, which is actually bad for the housing market. If you guys have been watching my previous videos for a while now, then you will know what my favorite market is. So go back to my older videos and find out which market I'm personally most bullish on and the reasons why. In conclusion, 2022 is definitely going to be a very interesting year for the property market, and there are definitely a lot of factors to consider and monitor. Based on the macroeconomic factors and what we can learn from history, I think there will be winners and there will be losers. The winners will most likely be the markets where affordability is not an issue, meaning that they are less sensitive to interest rates. And the losers will most likely be the markets that are highly sensitive to interest rates, those markets that are more leveraged. For that reason, I think Perth, Brisbane and Adelaide will be strong performers in the coming years, while markets like Melbourne, Sydney and maybe even Hobart might struggle a bit. I do agree with the bank's forecast that 2022 will be a great year for the housing market, but we need to be very careful if we are investing in 2022, because 2023 could be quite tricky for some of our markets. Alright, that's it for me guys. I want to thank you guys for watching the video till the very end. If you got some value out of it, please do me a huge favor by hitting that like and subscribe button right there and let me know your thoughts. Stay safe out there and I'll see all of you guys in the next video.